Dan Lewkowicz, Senior Director at Encore Real Estate Investment Services. Very excited about this presentation we have today with a good friend and client of mine, Ben Soifer. A lot of people ask me questions about shopping centers. How do your clients underwrite shopping centers? How do they know a good shopping center from a maybe not good shopping center? What are the red flags they look for? So because of that, Ben and I put together this presentation where we're going to go through and look at multiple shopping centers and tell you exactly what we think in terms of, is this a shopping center that an investor should buy? Is this a shopping center an investor should pass on? And most importantly, why? So, just as a little aside here, Ben and I became friends several years ago, actually through a shopping center deal, which you'll see here shortly. Ben purchased a shopping center through his fund, and we've been in touch ever since, underwriting deals together, looking at deals together, just finding ways to create win-wins so that we can do more business and help each other grow. So, Ben, unless you wanted to add anything else, I was going to jump right into this presentation.
Yeah, we really started focusing on the mission of making investing easy and being able to help investors out there really understand, the big red flags that they should be looking for when analyzing a property. Commercial, industrial, retail could be very, very challenging to a lot of investors. And there isn't really up-to-date, reliable information that's available. And I feel like our presentation, our talking points are really going to help a lot of investors out there kind of say, okay, I'm not as scared of it now. I understand the meats and potatoes of the deal. I understand, how I can get to the promised land and how I can achieve my financial freedom quest through acquiring these types of properties. And the most important thing is we're going to try to make it on the faster side. We don't want any investor sitting there for hours analyzing a property and getting confused as they're looking at different aspects and as they're making their list of do's and don'ts. We really, really want to make it easy. Part of getting CIDC certified and becoming a commercial investment debt consultant is really understanding what investors should be looking at and what will make their life easier. And again, really accomplishing the mission of their own path to financial freedom. So let's get it going. I'm excited.
Yeah, myself as well. And, Ben said it so well there. Over the last year, Ben was just telling me before this presentation that over the last year, he counted, and I've sent him 40 or 50 deals. And I think it's so important what Ben said about being able to understand what to look for very quickly. And you'll see here today just how quickly we're able to underwrite a deal and give it, a thumbs up or a thumbs down, so to speak. So here's our presentation. Again, I'm Dan Lewkowicz, Senior Director at Encore. Ben Soifer is with us as well. And I just think this is an incredible opportunity to learn from someone who's incredibly seasoned in the industry and successful. So we're going to look at the first shopping center. This is actually the Georgetown Retail Center. This is the shopping center that I sold to Ben that started our relationship. And I reached out to Ben because I knew he was somebody that was a well-qualified buyer who was going to move quickly and be able to give me a yes or no quickly, which he did very, very, very quickly. So Ben, did you want to take a look first? We can look through some of these parts of the deal and see what we think.
Yeah, so we want to look at the price per foot. Price per foot is very important. And obviously each economical area has its own price per foot factors, and that's something that you have to investigate as an investor. Over here, it's $176 per foot. At that particular list price, we actually ended up buying it for less than what it's showing. You also want to see that your return at that time when we were buying it, this was July of 22, debt was hovering around 4.5% to 5%. So if you're purchasing a property at a cap rate of 6.5, which again, that's what it was presented at, we ended up trading the deal at roughly 7.25. So that's where we were able to make our ROI be closer to the 10%, which is what we're looking for. The year built being 1990, so we're looking for properties that are roughly 20, 30, 40 years old, nothing really newer than that, and nothing really older for the most part, unless it's, an incredible deal, just because it gives you enough season to be able to see which tenants were able to stay there. We love seeing where tenants have been at the property for more than a decade. That's really nice to see. We were able to actually, since we acquired it, we were able to fix, for example, you see the gross lease on the right, and there are other, different ways of being able to receive the CAM that you should be collecting as a landlord. So it's been a great asset for us. We're excited about it. It's in a good area, and it's performing well.
Yeah, excellent, excellent. I love it. I mean, this property had great traffic counts. Grand Rapids is an incredible market here. You'll see, great activity, a lot of retailers in the area, close to the freeways, high traffic counts, as I mentioned, and then the demographics are very strong. This is a very much a growing market, which is important. So the next property here is a retail property in Dallas, Texas, on Samuel Boulevard, and we're going to take a look at it. Very different property. So Ben, did you want to, make any points known right off the bat about this asset?
Yeah. So again, what are we looking at first? So this is located in Dallas, right? We can see we're looking at the structure. It's telling you the roof is flat, built in 1946, all basic stuff. Occupancy 91%. We can scroll down to the next page. We could see kind of the retail hub over there. We could see obviously a lot of traffic off the highway. We can go to the next page. And over here, it's an analysis of the potential loan that the offering broker feels that a borrowing entity will be able to receive. It's always important for all investors to have their own go-to lending and be able to really do the numbers. That's why being a debt professional is really important, because we borrow money in order to make money. So let's move on to the next one. This is our rent roll over here. And we could see that you don't really have a true anchor. Family Dollar is your anchor here, 8,500 square feet, 35% of the occupancy. I personally like to see the anchor being between 25 to 40% of the total square footage. Then when you look at how long these guys have been here, you could see the lease started, for example, 23, 2019, 2018. So fairly on the new side. Family Dollar has been there. They've been there since 2002. And then you got Cliff Check Cashing, also been there since 2007. So as you could see, 80% of the tenants have changed. And that means that someone didn't make it. How long was it in between the tenants? That's something you have to investigate, normally with the management company or whoever was running the deal. This is the cash flow scenario. Here, I really focus on the NOI. You guys see the net operating income. So I verified that the NOI is actually, doesn't have any red flags like the real estate taxes. That's a big one. Each state obviously has its own factor. And a lot of times in the OMs, the real estate taxes aren't quite accounted for. And a lot of times the brokers will tell you, well, it's a triple net property, so don't worry about it. But you always have to worry about it. As an investor, you have to do your numbers right. So,
yeah. Red flag here too, Ben, I'd like to hear what you have to say is that, if you're looking at a building that was built in the 40s, so we're looking at 80 years old, right? They're having a capital reserve of 20 cents a foot, which is only $4,800 a year. An old building like this, in my experience, is going to have a lot more that's going to come up in maintenance than a newer building like the one you purchased, Ben, that was built in 1990. So I would wonder if this number is a little bit light on the $4,700 a year.
Yeah, possibly, definitely. These are things that I typically don't get into until the secondary due diligence. Again, we try to go through the offering in a reasonable amount of time without really putting in due diligence into a deal we're not under contract for. So that's something else to keep in mind. So this would be a no for us. Let's see what else we have as we're going through the pages. And again, as we're looking at these properties, if location, right? So there's always an exclusion to a rule, and our rules are obviously to purchase properties that provide the best price per foot, are in a good location with a good tenant profile, but you don't necessarily get all of these.
Okay, so this is another property. This is an interesting one in Alvin, Texas, which is a suburb of Houston. So this is directly across from a large Walmart and nice looking, clean shopping center. It's called Alvin Shopping Center in Alvin, Texas. And this one is price per square foot a little bit higher, I know, than you like. Year built, a little bit newer, 2002. Asking cap rate, 7% cap rate. And then a very big difference here. I know the 5 mile population on the last deal was about 380,000. Here, the 5 mile population, despite it being a suburb of Houston, is only 50,000 residents. So a lot lighter, better than 18,000, but still not like the properties that we were looking at prior.
So as you go through this package, let's go to the next page. Yeah, so we can see, let's go to the map where the Walmart is, just real fast. Yeah, so you definitely, this is where you would have to study, obviously, the entryways into the
Yeah.
into the subject property. And as you continue through the package, by the way, the price per foot, given that it's a newer build, isn't much. I mean, it's not, too expensive, but the area, can you focus on the map where the property is at?
Yeah, I mean, you see there's no real direct ingress and egress to the highway, although you can go by this gas station over here.
Yeah.
Which is interesting. The Walmart also has that same positioning, which is actually, but the Walmart, it looks like, yeah, they have this, is that the same entrance right off of the bypass? It looks like it. Yeah.
Let's take a look at the rent roll. So for the most part, small spaces. So this is like a Walmart shadow. That's what it's called, in the business. And anytime you're shadowing, you're dependent on your anchor. So that's something that investors out there should really be aware of. This would be a no.
This is Golden Triangle Shopping Center. Interesting setup of the actual plaza. This is in Dallas, Texas, and $9.1655 million ask. Over 66,000 square feet, 7.16 acres, built in 1965, asking cap rate at 9.14. So that's already, we're wondering, this is either it's a good deal or there's something going on. And remember, this one is
remember, not to cut you off, remember, Dallas is a big market.
Yeah.
So anytime you look at properties in big markets, you got to be a player there, or you got to have management companies that you feel comfortable with. As you could see, a lot of competition. So if you're going to have a vacancy, you're really going to have to work it unless there's a high demand just for your property. And that's what we're doing by analyzing these.
Yeah, and I do like right off the bat, you've got multiple points of ingress and egress. Here you've got an exit right off of this freeway that sees 83,000 vehicles per day going right in front of your shopping center. And then on Polk Street, you also have it. You've got a gas station, making it convenient for people to come in, do their shopping, get their gas, get back on the freeway. So I definitely like that. And I like, just the general population density. But now, I'm starting to look at the center, and you do notice some of these, older, lower end looking finishes and just overall feel of the center.
Okay, look at the tenant profile. No, I saw that it was 113, and then they're offering it for 9 million. So I don't know if investors out there should know that Texas is closer to the 2.8%. So just off of rough math, you're at about 180,000 where you should be on the taxes, as opposed to the 113. It's a big difference. That changes the NOI dramatically. So now look at your tenant profile, all small, besides Malone's Cost Plus supermarket. And the supermarket is 22%, and the supermarket's been there since 2015. You've got Family Dollar, who's been there since 88. So you know that someone was there before the supermarket and didn't make it, and that was a big space. And then you got tons of small ones. So you could see that the small ones have been there since 16, 15, 18. This is a good center for an operator that really wants to be hands-on, because this type of a center can definitely perform. As you could see, the tenant profile that, it's showing that it's performing, but based on the history, you could see that it's not necessarily the easiest, and also being part of a big retail hub. This is the type of investment, like I said, that's good for an owner-operator that wants to be involved closer with the management company, and really, because there are still vacancies, and you got to find out what's going on. Why are they not being filled, and what it really takes to manage this type of a property. But it has a couple of really good points, like the AT&T cell tower. That's a great moneymaker, without having to provide actual real estate, right? It's a cell tower. And then you've got the billboard, same thing. And I don't know how many of you out there knew that, but you can actually carve it out. If you purchase this property and down the line you say, you know what, I don't live in Dallas anymore. I don't want to be a part of managing this property, but I want to keep the cell tower and the billboard. You can carve it out and sell it without it. So these are very good selling points for this particular property. the fact
Yeah,
that,
absolutely.
yeah.
Absolutely. Here's another one, San Antonio market. This is called the corner at Southwest Military. A nice, interesting tenant mix here. So we're going to go through this one as well. $4.397 million ask, 7.5% cap rate. This is much newer, 2008, 22,000 square feet, 2.21 acres, and it's just under 93% occupied. However, as Ben had indicated previously, $200 a square foot, not bad for a building that's built, in 2008. So here's the rent roll, Ben, if you want to take it away.
Yeah, so again, it's given the fact that it's built in '08, you've got lease execution here on Hacienda Vallarta in 20. Then you have Vapor 2019. State Farm looks like an original tenant. Therapy, again, new tenant. Regional Finance, new tenant. Temptation, new tenant. So it's really indicative of the types of the retail space. The retail space is, unless it's a really needed business, a dialysis clinic, a grocery, store, something that's needed. A lot of times they're not going to make it in their first 5 years, or it's just not happening. So we would shy away, even though we love San Antonio, and everybody would love to obviously own a brand new product, 2008.
Yeah.
But when it comes to real estate, it's actually better to have something a little bit older, because at the end of the day, good construction doesn't really get old. It's good construction.
That's absolutely right. Yeah, no doubt about it. Yeah, a lot of good things about this center, but has its challenges as well. The next one is Summit Point Plaza. Okay, so this is a different shopping center here. Looks a little bit newer. Yeah, 2008 again. So we're looking at a $7.5 million ask, 34,000 square feet, 4.27 acres. This is in Oklahoma City, Oklahoma. It's a 7.3% cap rate at ask, 93% leased, and it's got a great national and local tenant mix. Obviously, in this market, it's also going to have good population density and demographics. We'll see that in a minute, but first we're going to go to one of our first stops, as everyone can see, the rent roll. So Ben, if you want to tell us your thoughts here on this rent roll.
So again, for the most part, it doesn't have a tenant that is a true anchor. And if you don't really have a true anchor, it's a problem.
Yeah.
And then you have your dates of, the lease commencements, and you can see kind of how long the tenants have been there. Something else that I didn't touch upon is, if you look at the rent per square foot, that's another red flag that you should always look at. If you've got tenants that are paying $12 a foot, like Uptown, and then you've got tenants that are paying, $28 a foot, like T-Mobile, and it's a store, it's not the cell tower, then that's good. You have room to obviously increase your rents. But is it realistic? Is it reasonable? Doesn't make sense that, a certain tenant is paying a certain amount. In this case, 100%. I mean, T-Mobile has been there since 2007. You could definitely see that, they're paying what the location calls for. So as a property owner, as a manager, your job is to really, bring up the rents to as close as you can to market.
Right.
Of course, you want to give a good deal to your tenants, but at the same token, you also have to be true to your own investment, to your investors, to your capital. And if you're not raising rent accordingly, then that's a problem.
Yep, very, very well said. And obviously people can understand T-Mobile, if they're a good location, are going to be doing significant sales that will justify that higher rent. But Ben picked it out real well. Those ones that are, just in the lower end, great opportunity to increase your NOI by raising rents at the appropriate times. Like the density here. Love this pop. I mean, you can see right here from these aerials, the population density is incredible. Amazon has some fulfillment centers. That's great.
If you go to the previous slide, right there where the site is, you can see that you're really off the main retail hub.
Right.
So anytime you're going to be a little bit away, in order for you to occupy your vacant spaces, you're going to have to discount your rent. And that's why you see discounted rents in some of these, spaces that got occupied.
Yep, absolutely. Here's another one Ben and I have looked at previously. I think this one shows very well when you look at it from an aerial, full parking lot, nice, L-shaped center, just presents really well. This is Westridge Plaza in Topeka, Kansas. And we're going to see here some, interesting factors as to, why or why not this is a deal to proceed with. So first of all, just the overall, description, 90,253 square feet, 13.91 acres. They are two different parcels, built in 1988, renovated in 2013, 98% occupancy. 16 tenants, and then an incredible 772 parking spots, which I find fantastic. So yeah, average weighted lease term is 3.1 years. And there's, $1.349 plus million in place NOI. So we'll take a look here. Obviously, a little bit of information. Let's go straight to the rent roll.
Yeah, so we got the Dollar Tree, 12,000 square feet, and there's the TJ Maxx, 24,000 square feet. But the main thing that I really want you guys to focus on is the gray area on the bottom where it says an NAP, not a part of the offering. So you've got Target, you've got Noodles, you've got Ashley's, you've got Planet Fitness. These are all huge draws that are adjacent to your property if you buy it, and you cannot control them. You cannot, have a say in what's happening with their leases, in what's happening with their continued operation. So it's always, to an investor, kind of an unknown. And anytime anything is an unknown, you should consider it as a red flag. Not to say that you wouldn't buy it, because obviously plenty of properties are considered shadow Targets, shadow Walmarts, no problem, but you have to really feel stable enough about your investment that you're not concerned about your anchor. And you could see where Westridge Plaza is it's quite away from the other plazas. It's really its own kind of small retail hub, which is 90,000 square feet is definitely a big size for that. So
yeah,
the demographics are phenomenal,
Yeah, here's the expenses though. Is this going to be what you want to look at?
Yeah, I mean, this helps you out kind of a little bit on how insurance is also a big, red flag. It's not really a red flag, but it should be a red flag at this point, because purchasing commercial properties, it's not easy to be able to get insurance and to be properly insured. So they have the insurance at 16,000. To me, that's
13,000 even. Oh, you're right. Yeah.
Yeah, to me, that's extremely low based on what's other properties. I would guesstimate it to be at least 40 to 50,000,
Wow.
like triple that amount. But obviously, that would be something to look into during the due diligence period. Then you've got your management fee, which again should range between 3 to 5%, give or take. So you can always double check on that. And then you've got your property taxes that I don't know what the percentage is this is in Kansas, right?
Right.
Yeah. So that's something else that again needs to be looked at. We can see what else do they have in the package. Some of these packages will be very long with information that's really not necessary.
Right.
This is the good stuff right here, the rent roll. This is where you can really see what options you have on your leases. The Cato Corporation, for example, who's a good operator, been there since 2012. You've got Crumble Cookies. Obviously, that's a good operator, but they only just went in, so they've got a lot of options to stay. Let's see what else. Who else is on the profile? Let's keep going. Yeah. Famous Footwear. Yeah. And then you've got TJ Maxx and 89. So the question is, can we see the sales that TJ Maxx is doing? And then
probably, because if you notice here in the comments and encumbrances, it says that there's a percentage rent clause. That's 2% of the gross sales, excluding the following breakpoints. So the landlord's going to have access to the sales. That's for sure.
So that's something that's definitely going to be, you would need to compare this store to how the other stores do.
Right.
And then based on that, see, have a good feel to how your store will continue to operate. But that's what you have to do as far as your due diligence. Same thing with with Dollar Tree. Same thing with Dollar Tree. If you're able to see how does that location do in comparison to others.
Yeah, absolutely.
Sometimes you might be able to even get numbers for properties that are not part of your purchase from, like the Ashley and potentially other tenants, if you're friendly enough with the brokers that handle that deal or manage the deal, because a lot of times it's really almost like public information. There's really nothing to hide, and it only works to the benefit of the tenant.
Yeah, absolutely. That's the more information you can have, the better, no doubt about it. Overall, a nice center. I know, Ben, you don't like the fact that there are, these, large parts of the actual, that are not included in the sale. So I know that lack of control is concerning, but overall, I think it's an interesting property to consider other than that.
It is an interesting property, but more importantly, it's at this point, it's not, coming at us with a deal that we cannot, pass.